Illustration number 7 includes unrealized profit on unsold stock as well as intercompany owings. These two adjustments are going to be carried over. Gold Limited, the transferee company. Silver Limited, the transferor company, amalgamating an exchange of the stocks from Gold Limited. So now what happens? Silver is merged with gold. Gold will be continuing. Silver will be closed. And the payment, purchase consideration will be in the form of share exchange ratio. Okay. And their pre-amalgamated balance sheet is also given here. Right. So past journal entry in the books of Gold Limited only. Transferee company. Prepared post-amalgamated balance sheet of Gold Limited. And we have to solve this under pooling as well as purchase method both. Okay. For each shares held in Silver Limited, 2 shares of Gold Limited were given in exchange, and face value being 10 and premium being 25, as the market price of Gold Limited share is 35 rupees. So purchase consideration. So purchase consideration here is equal to shares of gold will be offered to the equity shareholders of silver, equity share capital of gold. Apart from that, securities premium is also there. Share capital 10 and securities premium being 25. Okay. So 2 shares are going to be offered. 2 shares for every shares. For every shares. Okay. How many shares are there? In silver, in lakhs, 40 lakhs, otherwise 4 lakh shares are there. So 4 lakhs. For 4 lakhs, 2 shares. For every 1 share, 2 shares will be offered. For 4 lakhs, 8 lakh shares will be offered. Per share face value being 10. 80 lakhs will be the equity share capital value. And this will be, okay, this will be 25 into 2 into 4, 200. So the purchase consideration being 280 together with the securities premium. If you remove the securities premium, the purchase consideration is only 80. 280 will be inclusive of purchase securities premium. Without that, it's only 80. The fair market value of the non-current investments and stock of Silver Limited was assessed at 70 lakhs and 20 lakhs respectively. Okay, fair market value. Non-current assets and stock. Stock being 20 lakhs, fair market value. Non-current assets being, how much is that? 70 lakhs. 70 lakhs. Actually, the market value will be taken care or recorded only at the under purchase method. In pooling of interest method, we never bother about the market price. Also consider the following. Silver Limited sold goods worth rupees 10 lakhs, including 25% profit on cost to Gold Limited on credit. Right. Silver Limited sold goods. Clear? Gold and silver. Gold and silver. Sold goods worth rupees 10 lakhs, including 25% profit on cost. So cost, profit, sale price. If the cost being 100, 25 will be the profit added. So 125 will be the sale value. The sale value in this case being 10 lakhs, naturally the profit included in this being 1/5 2 lakhs. The cost of that being only 8 lakhs. Gold Limited immediately accepted bill for rupees 5 lakhs, leaving 5 lakhs unsettled. Okay. So from this it is very clear. BR and BP will have the value of rupees 5 each. Okay, BR and BP. BR and BP. Okay. 5 lakhs each. Remaining 5 lakhs remains unsettled. Unsettled means what happens? In the books of gold, silver will be creditor, and silver's book, gold will be the debtor. Okay, because silver is selling. Okay, the sale value being 10 lakhs. The sale value being 10 lakhs. So naturally, the original due being 10 lakhs, waived 5 lakhs and 5 lakhs. For gold, it is bills payable. For silver, it is bills receivable. Another 5 lakhs will be, for the gold, it may be creditors, for silver, it may be debtors. Am I right? Okay. Silver Limited discounted Gold Limited's bill for 1 lakh and endorsed 1 lakh to creditors. Out of this 5 lakhs in silver, discounted 1 lakh and endorsed 1 lakh. So still, how much remains commonly in both the books? Only 3 lakhs. So mutual owings can be cancelled only to the extent of common value in both the companies. Gold Limited sold 60% of the goods received from silver. So out of this, sold being 60%, 1.2 lakhs could be realized. Once it is sold, the profit is realized by both the company. To the extent of unsold remains unrealized value, which is 8.8 lakhs. This 0.8 lakhs is nothing but unrealized profit. This 0.8 lakhs is nothing but unrealized profit. Is that clear? So the purchase consideration being 280. Subsequently, we have to handle this one separately in the books of the Gold Limited. Okay, clear? Now, how to pass the entry here? These two entries are common. I'll post that here. For cancelling the BR and BP, 3 lakhs cancel, as well as debtors and creditors are also going to be cancelled mutually. Apart from that, unrealized profit should be adjusted in profit and loss account as well as in stock account. Is that clear? Now, let's see the purchase consideration being 280. Okay. Now, what's the journal entry here? In the books of gold, business purchase account debit to liquidator of silver, the value being 280. For that, various assets and liabilities are taken over. Various assets and liabilities are taken over. So I put that value here. Yeah. Business purchase account debit to liquidator of silver company. And business purchase is now replaced with various name. Now I'm going to follow which method? Purchase method first of all. Under purchase method, take all the assets and liabilities. These are the 4 assets we have along with the non-current assets. Apart from that, current liabilities will also be taken here. Resource and surplus will not be considered under purchase method. Non-current assets, you have to consider the realizable value. Under purchase method, we have to record at its own realizable value 70. Stock, today's value being 20, and debtors, the value being 15. BR, the value being 5. I just copy all these values and this one. Okay. Bank, the value being 5. 70, 20, 15, 5 and 5. Right. To what? To here. Trade creditors 15, to bills payable 5, to business purchase 280. Find out the difference if any. The difference will be named as either goodwill or capital reserve. You get goodwill being 185. So goodwill should be in the debit side. 185. Next journal entry is the settlement to the liquidator of silver company. Liquidator of selling company, silver company account debit. The payment being in the form of equity share capital as well as to securities premium. Securities premium being 200 and say equity share capital being 80. So overall value being 280. 280. So I just posted this value. Now I have to pass the entry for these values. Let's see here. Out of bills payable and bills receivable, 1 lakh being discounted, 1 lakh being the endorsement, another 3 lakhs could be what? Pending. Okay, in silver limited, 3 lakhs represents the BR from gold limited. Here we have been given 5 lakhs. In that 5 lakhs, 3 lakhs is from gold. Actually, gold accepted for 5 lakhs. But only we have 3 lakhs here. 2 lakhs could have been endorsed as well as discounted. So the mutual owings in this case is only 3 lakhs. So you can cancel only to the extent of mutually available in both the company. Asset is cancelled. To cancel the asset, it should be credited. The liabilities is also being cancelled, which is usually in credit. To cancel that, it should be debited. So the entry being bills payable account debit to BR account, the value being 3 lakhs. Another 5 lakhs remains unsettled, debtors and creditors mutually. Creditors is also be cancelled, debited. Debtors also be cancelled by debiting. Value being 5 lakhs, 5 lakhs. 5 lakhs, 5 lakhs. Is that clear? Unrealized profit 80,000 should be adjusted now. That will reduce the stock value. We thought the stock being 20,000, 20 lakhs. But this 20 lakhs includes some unrealized profit, so you have to remove it. Okay, this 20 lakhs. Okay, whose stock is this? Okay, the stock is being selling company. Their stock includes, they're not their stock. When you combine both the stock, okay, the gold company stock includes, because silver company only sells the stocks to gold company by adding the profit. If you are merging both the stocks, and gold company now knows that there is a profit in that unrealized, should be now removed. So for that, the journal entry being simply can be debited to goodwill account and stock account, to stock account. Either it can be debited directly to the P&L account or goodwill account. So I debited here goodwill account, the value being 0.8 lakhs. 0.8 lakhs. Clear? Clear? So purchase method is over. So I passed all the entries. I am going to now record the items here. So I'll start with the balance sheet of gold only. Balance sheet of gold. And then their notes to accounts. Their notes to accounts. I may just do corrections here itself. Okay. Yeah. So business purchase is going to be cancelled. Once again. Yeah. Business purchase got cancelled. Business purchase. Liquidator got cancelled. Then non-current assets 170. Non-current assets 170. Already we have 110. So along with that 70, hereafter it is 180. Goodwill. This is tangible assets. Goodwill being intangible assets. This value being 185. But we can add one more 0.8 with this. So 185.8 will be the value. 185.8. Is that okay? 185.8. stock 20, their stock 40, 60, stock value reduced by 0.8, 40 plus 20, 60 minus 0.8, what's the value? 59.2. Okay, 59.2. Okay, 59.2. Debtors 15 and 20, 35. 5 is cancelled. Now we have only 30. BR 5 and 10, 15 minus 3, 12. Bank 5 and here is another 10. So 15. Creditors 15. Here is 40, 55. 5 is subtracted. Ultimately 50. Bills payable 5, 20, 25. Cancel 3. So we have 22 here. 22 will be the value. Equity share capital already 80, another 80, 160. Securities premium, reserves and surplus, we have securities premium also. This is reserves and surplus, profits and losses. Securities premium being 200 and the profit and loss remains same, its own profit, and this 60 current liabilities will be totally changing. No, okay, the new current liabilities being 72. Current assets total being, come on, hope it is 111.2, 111.2, 111.2. Get me the total of the balance sheet. 111.2 or come on. 116.2. Okay, 116.2. Okay. And if you add up all this value, the balance sheet total should be 372. 372. Am I right? Hope now you'll be able to understand this. Clear? 372. So we have completed the pool and purchase method. We have completed the purchase method. Four? 482. Okay. So 482. 482. Okay then. It's tallying, right? So 482 is the new answer. Okay. Shall I move on to the next illustration? I am going to solve the same illustration under the other method now. Under the other method. Clear? Now, what happens if I solve this under pooling of interest method? Under pooling of interest method. So under pooling of interest method, we do corrections only in one place. We have to take the resource and surplus as it is here. We don't have the goodwill. I just do the corrections here. We don't have the goodwill here. And stock will be shown at what value? Book value. Book value of the stock being 15. Book value of the non-current assets being 60. So 15 and 60 will be the value I am going to show here. This is 60. This is 15. Apart from that, you have to maintain the resource and surplus also. The resource and surplus of silver company being 40. Resource and surplus. So, to resource and surplus, 40, am I right? It's 40. Now find out the difference. 240. Now find out the difference, if any. Make it faster. 240 you are getting difference. Yes or no? You have 240 should be subtracted from here. If you subtract 240 from here, you will get the negative resource and surplus. Negative resource and surplus will go debit side here. 200. Is that clear? Small change. Small change. Resource and surplus. Rest of the things are the same. Rest of the things are the same. So what the thing you have to do? It is not realizable value, it's book value. And then the resource and surplus will be taken. Not only that, if there is any profit and loss, that profit and loss will be adjusted only in the resource and surplus. Is that okay? Keeping this one, you can simply change the purchase method into pooling of interest method. That's all. All other things will be the same. Now we can simply solve the illustration. Business purchase got eliminated. Liquidator of silver company, liquidator of selling company, silver company also cancelled. Rest of things are going to be shown here. Resource and surplus debit 200, and don't show the goodwill here. It should also be converted into resource and surplus, profit or loss. So we already have 200 debit and 0.8 debit. We have the balance 50 credit. What's the value here? 200 and 0.8 minus 50. What's the ultimate value? 150.8. So 150.8 being the negative value. Negative value. Right. Non-current assets being 60. Already 110, 60 is added, so 170. Stock 15. Already we have 40. 40 plus 15, 55. That's a deductions of 0.8. Come on, tell me. 55 minus 0.8. 54.2. 54.2. And debtors 15 and minus 5. Hereafter it's only 10. With that you add 20, so it is 30. BR 5 minus 3, 2, and here 10, so 12. New one being 12. And bank, already we have 5. Here is 10, so 15. Trade credit as 15 minus 5 becomes 10. That will be added with the 40, so it is 50. Bills payable 5. 3 subtracted. Now the bills payable being only 2 is added with the 20, so 22. And the equity share capital, already we have 80 plus 80, 160. And securities premium 200. A new item comes here. Securities premium 200. Right. Now current liabilities new total being 72. Current liabilities new total being 72. And current assets total being, come on. How much? 111.2. Okay, 111.2. Now get the total. 281.2. Good. It's tallying, right? 281.2. It's now tallying. 281. Yeah, it's tallying, right? In Singar it can be text. No, I have considered the purchase consideration without securities premium also. Okay, you can go and refer that one. It's pretty simple. If you don't consider the securities premium being part of your purchase consideration, then automatically what happens? This becomes only 80, and this will be omitted. The rest of the things are the same. Rest of the things are the same. Okay. So as the purchase consideration seems to be very, very lesser value, definitely there is a profit. Maybe capital reserve or goodwill may be reduced. Okay, to that extent. So here 185 no. If you remove the securities premium 200 rupees, automatically to that extent gain will be there, and this goodwill may be totally wiped off. Another 15 capital reserve may exist. Okay, capital reserve may exist. See the solution where I have given that way. Okay. So you get a capital reserve of 15 rupees. Directly you can compare what would be the situation if we don't consider the securities premium as a part of your purchase consideration. And in the case of pooling of interest method, automatically what happens? The reserves and surplus will be neutralized. 200 rupees is going to be removed from the securities premium. So there will be huge profit. Already there is a loss 200. So 200 loss and 200 gain due to the securities premium neutralized. So it becomes zero. Is that okay? That's how you can easily understand. Come on, tell me if you have any doubt, you can clarify now, else we'll go for the next illustration. I just give an update regarding unrealized profit on unsold stock. Unrealized profit on unsold stock. Okay. Unrealized profit on unsold stock. Now, two angles are going to be discussed. Probably buying company and selling company. If the selling company sells the goods by adding the profit, cost 1000, profit 200, sale price being 1200. Sale price being 1200. Is that okay? Selling company to buying company. Clear? Now this stock remains unsold. How about the journal entry in the books of B? Any of S is going to be closed, we never bother about that. So how will be passed? Entry will be passed. So either it may be debited to goodwill account or capital reserve as the case may be. If we have the goodwill, you can add further goodwill. If we have the capital reserve already, then capital reserve can be used. Used means can be debited. Usually capital reserve being the credit side. We have to now reduce the profit portion. The profit portion reduced will be only on the capital reserve. Okay, capital reserve account debit to stock. Clear? In case if you are following the pooling of interest method, you can simply charge to the P&L account. Simply charge to the P&L account. But in this case, you never bother about this. Now, if the goods are sold by buying company to the selling company ahead of this, cost being 1000 and profit added being 200, so 1200 is the sale price. 1200 is the sale price. Okay, how can we observe? In this scenario, in the books of B, no entry is required. No entry is required. But remember, while passing the entry for taking all the assets and liabilities, by the time stock will be recorded at its own original cost excluding the profit. So, selling company says our stock as per the book value being, sir, 1200. Buyer knows it is not 1200, where 200 is added while selling from by B to yes. So that 200 rupees is subtracted. This is called unrealized profit. Because I'm selling, the same goods is now returned to me. 1000 rupees worth of goods, by adding 200 rupees, I'm selling. Sometimes later you come to me again, sir, the product is defective or not required. Kindly take it back or exchange. If I'm getting the stock back from you, is it my 1200 being the worth? Definitely not. So I'm aware about the worth of the stock being only 1000. So I take back and I assume it is now only 1000 rupees. So hereafter I'm going to show at its own original cost. right? So usually it requires no entry. You can adjust this one and you can show this way. How? Okay, so assets account debit to liabilities to book business purchase. In assets, stock will be recorded at its own cost. Okay, at its own cost. You no need to adjust the value here. You no need to adjust the values. Separate journal entry is not required here under this model. Is that clear? We have completed this model, so now I'm moving on to the next model. 7A. I may solve this illustration a bit faster here. 7A. Okay, purchase consideration being the same. All these things are same, the same illustration. Okay, under 7A, it's a variation of 7 where Gold Limited sold the goods worth rupees 10 lakhs, including 25% profit on cost to Silver Limited. That's all. Okay, what happens? Goods is sold by buyer to the seller, gold to silver. Cost being 100 and profit added on that cost being 25 and sale price being 125. Here the total sales price being 10 lakhs and as this is being the 10 lakhs. Out of that the profit share being 1/5 2 lakhs, right? 60% of the goods received from silver. Silver sold. Silver sold these goods. How much? 60% already sold. Right. So the 8 lakhs will be the cost for total value where 60% sold. Balance is how much? 40%. 40% should be 3.2 lakhs. Now you have to show the value of the stock being 3.2 lakhs or this unrealized profit on the unsold stock 0.8 lakhs. 0.8 lakhs is going to be subtracted from the asset account, stock account. That's all. Rest will be the as usual. Rest will be the as usual. Is that clear? So what do I do? The unrealized profit being 0.8 lakhs. Earlier also we had the unrealized profit, but we adjusted that routed through a journal entry like goodwill account debit to unrealized profit or stock account we have done. But here you are not going to pass a journal entry while taking the assets of the selling company. You are going to pass a second journal entry for taking various assets and liabilities. By the time the stock's value should be after adjusting this 0.8. That's all. You no need to pass a separate entry. Is that okay? Now how should that be? Okay, all these things are same. All these things are same. I'll just make slight changes here. Slight changes. Okay. I'm going to correct here itself. I'm going to correct here itself. Right. What happens here? 7A. 7A. Stock will be taken at what value? 19.2. 19.2. That 0.8, this entry is not going to be passed. Rather than the deductions of 0.8 by passing a separate entry, while incorporating the assets of the selling company in the second journal entry, we show at 19.2. That's all. And all the other things will be the same. Because of this one, goodwill will get affected. So the goodwill should be 185.8. That's all. So you are merging this entry with this. You are merging. You don't need to pass a separate entry. You can merge. Then naturally what happens? Final journal entry will be the final balance sheet will be the same. Okay. In stock, the value being, yeah, everything is same, I think. Everything will be same. Only this change is done. So you are not going to pass a separate entry. That entry is also merged with the main entry itself. Clear? That's what about the illustration. In this illustration, we can understand. This is under purchase method. In case of pooling of interest method, the same way in pooling of interest method. 7A. This entry will not be passed separately. Stock value rather than 15.8 is subtracted here. 14.2 will be taken and resource and surplus will be now debited by another 0.8. Already resource and surplus is only in the debit side. By debiting another 0.8, it becomes 200.8. Rest of the things are the same. Is that clear? Hope you will be now able to understand this concept. If it is clear, text me so that we will move on to the next concept. Make it faster. Go and see the solution. I have not prepared any balance sheet here. I just passed the journal entries only here. So we'll now move on to the last adjustment, I think. With that, almost all the aspects are over. Only one aspect to be covered, which is fractional shares. It's not a big deal. It's a part of already learned one only. The last content I'm going to teach you here is all about realization expenses. Who is going to meet that? Okay. So what happens? We have completed the calculation of purchase consideration under all the model and basic problem on absorption under purchase method and merger method. Basic problem on amalgamation under purchase method and merger method also be discussed. And comprehensive problem in absorption as well as in amalgamation under both the method we have studied, where I introduced statutory reserve legally to be maintained for some more future years. In that case, under purchase method, we need to specially pass an entry for this. For merger method, we no need to pass any entry. And we have studied the sixth element, which is unrealized profit and unsold stock and intercompany owings. Actually, these two are the blend. Both will say together will come. Fractional shares already we studied, right? If the purchase consideration being 225 and we offer by way of shares. If we offer by way of shares, we will get 22.5 shares. 0.5 share cannot be issued, so 22 full share, and for 5.5, 0.5 into 1 share price 10, 5 rupees cash may be given. That's what about partial. But one interesting illustration regarding the fractional shares are there, so I may be solving that at the last. No need to worry about that. Before we go for the last element, let me finish up the realization expenses here. Of course, if you plan to close the business, you need to spend some money, right, to sell all the assets, and sometimes the assets may not be accepted by the buyer. I don't want to take up this asset. You just close it yourself. So the seller now sells some of the assets and he takes a responsibility to sell some of the liabilities also. So those cases, of course, they need to spend some money. Okay, realization for this process. Okay, so realization expenses. It is given here. Additional adjustments. In additional adjustment number 1, I have given all these things in detail. So almost 4 aspects are there in realization expenses. I am going to work out all these things or explain all these things in detail. In intercompany owings, we have 3 aspects and unrealized profit, 2 different aspects. Exchange ratio also complete. So all these things are available here. Now, what happens if you are paying any amount for realizing the assets and liabilities? Realization expenses. Realization expenses may be spent by selling company. Selling company. Yes, come on. What could be the journal entry? If you are spending any money, naturally it's an expenses only. Expenses to cash and later that expenses debited to the P&L account, right? P&L account debit to expenses or simply P&L to expenses. Sorry, to P&L account debit to cash. At the time of realizing, which is the P&L account like? The realization account is a realization account. P&L account like nominal account. So you can directly debit to the realization account here. So the journal entry being realization account debit to bank. Realization account debit to bank. Is that clear? Actually, the expenses entry being expenses to bank. Next being this expenses debited to the P&L account in the year end. If you club these two, the ultimate entry being P&L account debit to bank, isn't it? But at the time of closure, I am not going to open the P&L account. Instead of P&L account, equivalent to that, we have one more nominal account called realization. That's why it's realization account debit to bank. Clear? So you don't need to mug up. You can simply understand this. Now, if expenses met by purchasing company, come on, guess the entry. Purchasing company's book. In the purchasing company's book, how can you pass the entry? Selling company never bothers. Okay, you spend, then how do I worry about that spending in my account? I'm not going to show that in my account. Clear? Yeah, tell me. Huh? Bank is actually what? Credit. Bank is always credit, right? So it goes out. So to bank. What should be debited? Very good. So for them, if they are paying anything excess to their company's worth for taking up the assets and liabilities is a loss only. That loss can be either debited to goodwill or capital reserve. In case of pooling of interest method, normal P&L account. Normal P&L account. Clear? That's all. So scenario 1, scenario 2. This is scenario 1. This is scenario 2. Third scenario is nothing but a combination of these two. A combination of these two. Okay, combination. Maybe realization expenses 1 lakh. Out of that 1 lakh, selling expenses spends around 60. Purchasing company spends 40,000 rupees. For the 60, the journal entry being realization to bank in the books of selling. For 40, goodwill account debit to bank in the books of purchasing company. This is the third aspect. Now let's move on to the fourth one. In case of fourth one, okay, money is spent by selling company but payment is made by purchasing company or later on recovered from the purchasing company. This is the another angle. While spending the money, selling expense company will pass the entry what? Realization expenses account debit to bank. And then the realization expenses recoverable from purchase. It's not going to be debited their account because as per the contract, purchasing company says, don't worry, I will pay. Don't worry, I will pay. That's how the purchasing company stated. Now, selling company recovers that from purchasing company and sends the bill. Then the entry being purchasing company account debit to realization expenses. So now purchasing company being debtor for this amount. Later, he recovers the money from the purchasing company, bank account debit to purchasing company, settlement. Right. Ultimate entry being realization expenses debit, credit got eliminated. Purchasing company credit, debit got eliminated. Bank debit, credit got eliminated. So you no need to pass any entry here. You no need to pass any entry here. Okay, big zero. Then what about the purchasing company, sir? For purchasing company, this entry will remain because they have met these expenses. Then the entry being either goodwill or capital reserve or profit or loss debit to bank. Clear? Hope now you'll be able to understand. So here I have given. First one is paid by the transferor company. Paid by the transferee company. Partially paid by transferor and transferee where it's a combination of these two. Paid by the transferor company but reimbursed from the transferee company later. Then in the books of transferor, you can pass the entry. Purchasing company got eliminated, bank eliminated. So otherwise you can simply omit no entry in the books of selling company. But in the books of transferee company, regular entry will be passed here. Clear? Hope now you'll be able to understand this concept. Come on, make a note of it. So we'll go for solving an illustration in this aspect. Liquidation expenses. In this illustration, I have included the liquidation expenses, one of the beautiful illustrations chosen from the exam point of view illustrations collections, and balance sheet along with the notes to accounts given. Finally, show the journal entries in the books of Moonlight Limited, assuming that the entire sale consideration of 30 lakhs met by Sunshine Limited in the form of equity shares of ₹10 each in their company. So we have been given Moonlight, which is going to be taken over by Sunshine. Moonlight is going to be taken by Sunshine. Thereafter, Moonlight will be closed. Entire consideration of ₹30 lakhs. So from this, it is very clear the purchase consideration being 30 lakhs also be payable only in the form of equity share capital. That's all. So purchase consideration being in the lump sum manner, it is given. Lump sum consideration. Now you have to pass the journal entry only in the books of Moonlight. So you know that purchase consideration and close the companies, close the selling company, incorporate in the purchasing company, incorporate in the purchasing company. While closing, we can either pass a journal entry or sometimes we may be asked to prepare the ledger or both. Until now we have seen the illustrations with the ledger, but in this case we have asked only this part, this part. Here we have the journal entry as well as finally we have to prepare the balance sheet. They have not asked this one, not this one. Only journal entry in the case of closing the company is asked. And the purchase consideration also 30 lakhs. Keep the idea in your mind and pass the journal entry. What's that idea? Realization account, purchase consideration account, Sunshine purchasing company account, equity share capital account. What do you do? Record the assets here at book value, liabilities at book value, equity share capital as well as accumulated resource and surplus at book value. Is that okay? Then incorporate the purchase consideration here and here. Sunshine and purchase consideration, mode of payment and equity share capital of Sunshine will be transferable to the equity share capital here. So Sunshine equity share capital or equity share capital of Sunshine. On tallying that, you will either get profit or loss on realization account. Isn't it? We assume if we have the profit, this balance will come here. Now, pass the journal entry for transferring assets, pass the journal entry for the liabilities. Okay. Pass the journal entry for amount transferable to the equity shareholders and incorporation of purchase consideration, fourth entry and fifth entry, sixth entry. The mode of settlement is transferred to the equity shareholder, seventh entry. Profit and loss ultimately transferable to equity shareholders account from the realization account, eighth entry. That's how you can keep the idea in your mind. 8 sets of journal entries. All right. Okay. Now let's see here. A customer had lodged a claim of ₹5,000 towards defective parts purchased from the company, which Moonlight Limited has decided to meet from the provisions for warranties. Okay, from the provisions for warranties. Clear? Right, from the provisions for warranties. Okay. Do we have the provision for warranties here? Yes. From the 20, they decided to meet this ₹5,000. Clear? And apart from that, Moonlight Limited is taken over by Sunshine Limited as at the closure of the business hours on 31/3/2024. All assets and liabilities except cash are taken over. All the things are taken over, cash not taken over. If cash not taken over, it is going to be transferable to the equity shareholders only. And land and building valued at ₹12,000 prior to the acquisition. This is also prior to the acquisition. This is also prior to the acquisition. Expenses of absorption amounting to ₹60, which are borne by the Moon Limited and Sunshine Limited in the ratio of 4:6. So, as the total expenses 60 shared by Sunshine as well as Moonlight, they are sharing the ratio of 4:6. 4 share is for whom? Sunshine. 24 for Moonlight, sorry. 36 is for Sunshine. Am I right? That's how they are sharing. Show the journal entries in the books of Moon Limited, assuming that the entire sale consideration 30 lakhs was made by Sunshine Limited. So first, we'll close this entry. Number 1. Second entry being this one. Second entry. We close these two entries. We pass two journal entries before we proceed the subsequent means closure of the books. So for the payment of claim, what is the journal entry? For the payment of claim, okay, claim account debit to bank. Am I right? But the claim is adjusted with provision for warranty. So you can simply debit to provision for warranty. Warranty account debit to bank, or cash. The value being 5,000. The value being 5,000. Clear. Next entry being, they have to make the payment for what? There is an appreciation. Building value is appreciated. Land and building are appreciated. It's valued 12 lakhs. What is the current value here? 10 lakhs. So factory land and building is appreciated by 2 lakhs. Then land and building account debit to revaluation profit. This value being 2 lakhs. These two were done before what? Before closing the company. So before the selling company comes, I pass these two journal entry and show this is what about my new balance sheet. For that, provision for warranty and bank will be adjusted here. Provision for warranty is now reduced to 15,000. Bank balance reduces by 5,000. It is 65,000. What is not taken? Okay, except cash. So we need to use the cash only. So here 25,000. Is that clear? So I can name this being cash. We assume that bank is also taken over by purchasing company. We assume the payment is only by way of cash. Land and building is also be appreciated and revaluation profit emerges. So here the land and building being, rather than 10 lakhs, it becomes 12 lakhs. Apart from that, we have the revaluation profit of rupees 2 lakhs. So for the selling company, I am showing this balance sheet. So now the balance sheet being 5 lakhs 25,000 and this value being 70,000 and this value being 16 lakhs. This value being 9 lakhs 95,000. So resource and surplus being 5 lakhs 25,000 and current liabilities being 70,000, 5 lakhs 25,000, this being 70,000 and asset being 16 lakhs. This one reduced to 9 lakhs 95,000. Is that okay? Now what is a new balance sheet? Of course, this balance sheet not required to be prepared. You keep this idea in your mind, that's all, right? What is the total value now? 25 lakhs 95,000, 25 lakhs 95,000. Am I right? Okay. This one is over. This one is over. Balance sheet is over. Hereafter, we go for closing the company. While closing, you need to keep these ideas in your mind. 8 journal entries to be passed, one after one. Yeah, let's start with the first one. Record the assets here. So what are the assets we have? Non-current assets as well as current assets, these two. But anyhow, the breakup is here. So I'll take this breakup here directly. These two breakups. Non-current assets as well as current liabilities. Let's see here. And you have to debit to realization account. So realization account debit. Realization account debit. To what? Patent. Patent value being 1,90,000 and factory land and building 12 lakhs and vehicles being 2,10,000. Inventory to inventory 4,20,000. Sundry debtors the value being 4 lakhs 80. Cash in hand not taken over. Cash in hand not taken over. I'll keep it here. I have 25,000 in cash as on this date. Okay, those cash not taken over can be kept separately. Bank taken over, so this value being 70,000. So I have posted all these values. Okay. Assets transferred. What more assets we have? Nothing. We have completed the assets. Then we have to go for the liabilities to be posted. Liabilities. Liabilities and resource. Okay. So these are the items. These are the items. Now, what is the total of all these assets? Come on, tell me. 25 lakhs 70,000. The next we will move on to the liabilities to be transferred. So, number 1 over. Let's go for the number 2. Number 2 is nothing but transferring the liabilities to the realization account. What are the liabilities we have? These two. Apart from that, this one. Is that okay? So, provision for unexpired warranties. Provision for warranties. Already adjusted 5,000. We still have only 15,000. Creditors, the value being 55,000. Apart from that, we have the debentures value being no debentures, right? That's all, only these two. Okay, we don't have the debentures. To what? Realization account. The value being 70,000 rupees. Second step over. Second step over. Then third will be transferring the equity shareholders amount to their account. That's how you can keep the idea in your mind and you can post one after one easily. Clear? Now, for equity share capital, all these things are going to be transferred. What are they? These things and this one. Okay. All these things are going to be transferable to the equity shareholders by debiting this. Equity share capital of Moonlight Limited debit, value being 20 lakhs. Accumulated profits where we have the revaluation reserve. In the credit side, to cancel it is debited 2 lakhs. General reserve debited, value being 1,40,000. Profit and loss 85,000. Planned replacement reserve. Planned replacement reserve account debit 1 lakh. Is that okay? So I have posted all the liabilities. By passing these 3 journal entries, the balance sheet items are closed. Balance sheet items are closed. Assets transferred, liabilities transferred, and owner's fund also transferred. Now, what's the total value? To equity shareholders. Come on, tell me the value here. This one is 20 lakhs. First one. Huh? 22, 23, 24, 25 lakhs. 25,000. 25 lakhs, 25,000. Is that clear? 25 lakhs, 25,000. Then now we have to incorporate the purchase consideration. The value of purchase consideration being 13 lakhs, 30 lakhs. So you have to pass the entry for the 4th, 5th, 6th, and 7th. Right. So purchase consideration account debit to realization, value being 30 lakhs. We know already the purchase consideration being 30 lakhs. Lump sum method is followed. Then this purchase consideration is payable by whom? Payable by Sunshine Limited. So the entry will be now due entry for Sunshine, amount recovered from Sunshine. So Sunshine account debit to purchase consideration, the value being 30 lakhs. And next one is settlement. Sunshine offers us equity share capital of their company. So equity share capital of Sunshine Limited. To differentiate, this is Moonlight shares, this is Sunshine Limited shares. I use in subscript as SS. Equity share capital of Sunshine Limited to Sunshine Limited, 30 lakhs. The payment made by the Sunshine Limited by way of equity shareholder capital will be taken by the equity shareholders. For that, equity shareholders account debit to equity share capital of Sunshine Limited, the value being 30 lakhs. Apart from that, we have to find out past journal entry for the realization expenses. Past journal entry for realization expenses. What's journal entry for the realization expenses? Moonlight spends around 24,000. 36,000 spent by purchasing company. We never bother about that. They will show under goodwill or capital reserve or profit and loss account there. We never bother about. So here we have to just debit that to the realization account. So the entry being realization account debit to bank cash, to cash, the value being 24,000. 24,000. Already we have 25,000. Out of that, 24,000 is used for settling the realization expenses. Still we have 1,000 rupees can be handed over to equity shareholders later on. And the next one being find out the realization profit and loss to be transferable. How can you find out the realization profit and loss? You can simply open a rough note like realization to assets. To assets, the value being 25.7 lakhs. This one here, liabilities 70,000 and purchase consideration being the next one being purchase consideration, which is 30 lakhs. Apart from that, another payment for expenses 0.24 lakhs. And find out the difference here to identify the profits, loss and realization to be transferable. Is that okay? You don't need to open complete realization account. We need to know what is the balance. You can have the rough note like I think 4,76,000. So 4,76,000 being the profit transferable to the equity shareholders. So the entry being realization account debit to equity shareholders. This value being 4,76,000. 4,76,000. Whatever the cash we have ultimately can also be transferable to the equity shareholders. Okay. So out of 25,000, 24,000 used, still we have 1,000 rupees hand out to the equity shareholders. Like you can show here itself, no problem. You can combine these two or show it separately. Equity shareholders account debit. Any unused cash balance we have now can be used for paying any fractional shares to the equity shareholders. Cross verify to confirm whether the working is correct. So here by equity share capital as well as resource and surplus 25.25 lakhs and here is 30 lakhs. Equity share capital of Sunshine, they get 30 lakhs. And realization profit we have, which is 4.76 lakhs. And this one being to cash 1,000 rupees, 0.01 I think, 0.1 lakh. So 30.01 lakh, 30.01 lakh. It's now tally. Clear, cross verify. As we are not preparing the ledger, you will have lots of confusions how to proceed. Keep the ledger idea in your mind and each and every step should be correctly correlated in your mind so that you can handle it very easily. See, that's why I have given this picture. So in sometimes in the examination, they don't want to ask you to prepare the ledger directly pass journal entry. If you are asked to pass journal entry, you usually get messed up. Then you can keep all the ledgers in your mind, and the journal entry order from picking the journal entry order from ledger should also be correctly memorized, so that it will be very convenient for you, right? That's all. So one of the interesting illustration. Come on, make a note of it. Question number 9. In this case, the liquidation expenses is reimbursed. Right. X Limited decided to absorb the business of Y Limited. So X, Y. So Y will be closed. If nothing stated, you always follow the purchase method itself. Right. Now, at a respective book values and assets and trade liabilities except building, which was valued at rupees 12 lakhs, and plant and machinery 1 lakh. So they have taken all the assets and liabilities at their book value. But in case of building and plant and machinery, the value is totally different, 12 lakhs and 10 lakhs. Okay. So building 12 lakhs and plant and machinery 10 lakhs. This is 12 lakhs and this is 10 lakhs. New value. Purchase consideration was payable as follows. Assumption of trade liabilities. Means they are taking the trade liabilities. They will accept. And payment of liquidation expenses 5,000 and workmen's profit sharing fund at 10% premium. Right. So purchase consideration includes the liquidation expenses also. It's nothing but reimbursement. We are getting and using that money for liquidation expenses. Not only that, workmen profit sharing fund, no, that should also be closed. So the management offered them to the employees, if you are doing good job, you will be getting some premium. So that premium is calculated, that bonus is calculated and kept there itself, not settled. Due to this merger, the employees are in agitation, don't want to go with the new company. Yes, until now we want to know, settle me that bonus and all. So for that, this purchasing company offers you payment also. Okay, workmen profit sharing fund. 3 lakhs already we have. On settlement, we have to make a payment of 3 lakhs 10,000. Is that okay? Trade liabilities are taken over. This is taken over. Purchasing company is not taking this one. I'll give the cash, pay off it. Pay off it. Issue on 1 equity share of rupees 10 each fully paid at 11 per share for every preference shares and equity shares of Y Limited, and a payment of rupees 4 per equity share in cash. So purchase consideration being most probably seems to be based on the payment, net payment method, like equity share is going to be issued 1:1. Okay, 1 equity share of rupees 10 each fully paid at 11 per share for every preference share and equity shares. How many equity shares are there? How many equity shares are there? So 2.5 lakhs equity shares are there. No, for 2.5 lakh shares, they are offering 2.5 lakhs equity shares. And for the preference share also, they are offering equal number of equity shares. Okay, equity share capital of X Limited to the equity shareholders of Y. How many? 1 lakh, 1 lakh, 2.5 lakhs. Okay, 2.5 lakhs, 2.5 lakhs into 10 rupees. Then 25 lakhs. And of course, 1 rupee being the securities premium. 1 rupee being the securities premium, which is 2.5 lakhs. And equity share capital of X is offered to the preference shareholders also. Preference share capital of Y. 1 lakh shares, 1:1 ratio. 1 lakh shares are there for the preference shares. For every 1 share of preference shareholders will get 1 equity shares in the new company. So equity shareholders also getting the equity shares, preference shareholders also getting equity shares, not preference shares, right? And 1 lakh into 10 rupees is the face value, 10 lakhs. Of course, valued at 11, so 1 rupee excess payment will be considered as securities premium. This is another 1 lakh. Is that okay? Not only that, they are offering cash also. Cash to equity share capital of Y. How much? Payment of 4 per equity shares in cash. How many equity shares are there? 2.5 lakhs equity shares are there, and for every equity share 4 rupees is payable, which is around 10 lakhs rupees. Okay, this is cash. Not only that, cash is offered for what? Payment of liquidation expenses. Payment of liquidation expenses. For that, another 5,000 rupees. And they asked to settle the workman profit sharing ratio fund. So the purchasing company is not going to take any responsibility of paying this later period after the employee becoming our employee, right? Finish up that. So that value being 3 lakhs together with the premium 10%, 3 lakhs 30,000. Though it is only 3 lakhs, the payment is made at the rate of 3 lakhs 30,000 rupees, right? So cash is for workman profit. Workman profit. This is 3 lakhs. Now what's the total here? 51 lakhs 85,000 will be the purchase consideration. Clear? We calculated the purchase consideration here. Calculate the purchase consideration. Show the necessary ledger accounts in the books of Y Limited and opening journal entry in the books of X Limited. Right. We no need to pass the journal entry in the books of Y Limited. So we need to directly prepare the ledger. Clear? See here. Ledger preparation. Ledger preparation. Now, realization account. Realization account. Purchase consideration account. Purchasing company X account. And then the payment is done. Payment is done. Equity shareholders account. We need to get cash for various payments. It's better to open the cash account. Usually not required, but here we have lots of different payments. For that, we retain some cash, and using the cash, we are making the payment. So that we can open one more account called cash account. How can you proceed this? First, post all the ledgers, balance sheet items in the concerned ledger account to close the books of accounts. Right. Let's start with this. Okay. Now, GR and profit and loss will be for equity shareholders. Equity share capital. Oh, we have the preference shares also, right? So I need more space. Okay. Few more space. For what? Preference share capital as well as for cash. Preference share capital, and we have the cash for various payments. Close the books of account first. Okay. Let me finish up posting the notes to accounts in the concerned ledger. Thereafter, I'll go for the remaining items. Right. Now, reserves and surplus, profit and loss. Transfer up to the equity shareholders. So, reserves and GR account as well as profit and loss account. GR being 5 lakh 60. Profit and loss being 8 lakhs. And sundry creditors 4 lakhs. Workman profit sharing fund. Workman profit fund. Okay. WPF 3 lakhs. And goodwill value being 8 lakhs. I am closing the books of accounts are items available in the balance sheet, so I am going to show only at the book value. 8 lakhs. Building, 7 lakhs. Plant and machinery, 13 lakhs. Stock, 7 lakhs. Debtors, 9 lakhs. And bank, 6 lakhs 60. 6 lakhs 60. Hope now you'll be able to understand what I am doing. I'm just closing the books of accounts. All the items available in the assets balance sheet is transferred here. Still, we may have some more items to be posted. So, in this case, schedule number 3, 4 taken from the schedule, 2 also taken, 1 also taken. Only these 2 are going to be posted here. Preference share capital, this is preference share holders account. Preference share capital being 10 lakhs. Equity share capital being 20 lakhs. I just close the books of account by transferring all the items available in the balance sheet to the concerned ledger account. Okay. This one is over. Clear? Now I have to incorporate the purchase consideration. Here purchase consideration being 51 lakhs 85,000. 51 lakhs 85,000. Okay. Now workman profit is 3 lakhs 30,000. 3 lakhs 30,000, isn't it? Okay, okay. Making a payment of 30,000 excess, right? So then purchase consideration being 51 lakhs 85,000. I stand corrected here. This being 3 lakhs 30,000. Okay. Yeah, okay then. Then here realization account. To make it simpler, I just remove this. Here I need space, right? X. Here to realization or to purchase consideration, the value being 51 lakhs 85,000. How the payment is made? By way of equity share capital being 25 plus 10, 35 lakhs. Equity share capital of X. Securities premium being 250 plus 1, 3.5 lakhs. Balance being cash. Cash being 330 plus 50, 5,000 plus 1 lakh. 4 lakhs 35,000. Am I right? 4 lakhs 35,000. Hope now it will be tallying 51 lakhs 85,000. 51 lakhs 85,000. Out of this, equity share capital is offered to the equity shareholders being equity share capital of X. Offered to the equity shareholders being 25 lakhs. Securities premium being 2.5 lakhs. Offered to the preference shareholders to equity share capital of X 10 lakhs. Securities premium offered being 1 lakh. Right. In that cash, to amount received from X being 4 lakhs 35,000. Out of 4 lakhs 35,000, 1 lakh is for equity shareholders.
42 lakh 83,000. 42 lakh 83,000 on sale of purchasing.
Securities premium 3, cash being 4 lakhs 35.
42 lakh 85,000 is the total.
One second. 25 plus 10, 35. 2.5 lakhs plus 1 lakh, 3.5 lakhs. Cash being 1 lakh plus 330 plus 5. Which one 10 lakhs? It is 10 lakhs. Okay. Yeah, this one is 10 lakhs. 4 rupees now. 2.5 lakhs into 4, 10 lakhs. Okay, now stand corrected. Then here the cash balance should be 10 plus, this is 10 lakhs plus 330 plus 5, 13 lakhs 35,000. 13 lakhs 35,000. Now it is tallying, right? Okay. 13 lakhs 35,000. 13 lakhs 35,000. Out of 13 lakhs 35,000, 10 lakhs is for whom? Equity shareholders. So cash is given to the equity shareholders being 10 lakhs. 5,000 is for liquidation expenses, realization account. Okay, for liquidation expenses. Another one is for workmen profit fund. Okay. So, what is the journal entry for liquidation expenses? Realization account debit to cash. Okay, for what? Liquidation expenses, 5,000 rupees. Not only that, you are making payment for workmen profit sharing also. So, workmen profit fund for that 3 lakhs 30,000 rupees. Here, cash. So, goodwill, building, plant and machinery, stock, debtors, bank, for all these things put together, including creditors, one consideration is there, which is 51 lakhs 85,000. And this one remains unsettled, so it should be now settled by way of cash. Cash being 3 lakhs 30,000 rupees. Apart from that, this is for workmen profit fund. Another one being realization expenses. For that 5,000 is settled. Hope you will be now able to understand. So 51 lakhs 85,000 is for these ticked item, all the assets and one creditors only, not for workmen profit fund. For workmen profit fund, we pay out of the cash available with us. Clear? This one is over. This one is over. Now, find out the preference shareholders. By tallying the preference shareholders, you will find out the profit and loss. Of course, there's an excess payment by 1 lakh. That excess payment 1 lakh will be adjusted only to the equity shareholders fund. Or it can be transferred to the realization account. Ultimate value will be transferred to the P&L account. That way also you can solve. Right. What I have done in Singar Academy's text. Yeah, of course, this is transferred directly to the equity shareholders account. The value being 1 lakh. In the very first class, I think so, I explained this and I adjusted, routed through the realization account. In this class, I am going to route it through, adjust this routed through equity shareholders account. So here, preference shareholders account 1 lakh. Tally the realization account and find out if there is any profit or loss on realization. Cash account gets closed, 13 lakhs 35,000. It gets closed. 13 lakhs 35,000. Now, by tallying the realization account, hope you will be getting profit only. The profit is transferred to the equity shareholders profit. The total being 58 lakhs 85,000. 58 lakhs 85,000. Equity shareholders fund in this case being holders were being 4 lakhs 90,000. Transfer that to the equity shareholders account. So realization, the value being 4 lakhs 90. Now the equity shareholders account gets closed. Hope this value being 38 lakhs 50,000. 38 lakhs 50,000. Clear? Clear? Huh? Now, apart from that, we have to pass directly the books of purchasing company, right? See here. In the books of purchasing company, pass the journal entry for this first. So, business purchase account debit, business purchase account debit to liquidator of Y Limited, value being 51 lakhs 85,000. The mode of payment, liquidator of Y account debit to how the settlement is made, equity share capital, securities premium, cash. Equity share capital being 25 plus 10, 35 lakhs. Securities premium being 2.5 lakhs plus 1 lakh, 3.5 lakhs. Cash being 10 lakhs plus 330 plus 5,000, 13 lakhs 35,000. Overall payment to the liquidator of Y being 51 lakhs 85,000. 51 lakhs 85,000. For that, they are accepting various assets and liabilities. Various assets and liabilities. So the assets and liabilities list is here. Okay. What are the assets taken over? Leaving this, all the assets and liabilities were taken over at their realizable value. Okay. So what are the assets taken over? In case of goodwill, no, you can write it later on. Leaving that, you can start post other things. Building account, debit, this value being 7 lakhs. Plant, sorry, 12 lakhs. You have to show at the realizable value. Realizable value 12 lakhs. And plant and machinery, account debit, the value being 10 lakhs. Stock, debit, the value being 7 lakhs. Debtors, the value being 9 lakhs. Bank also taken, the value being 6 lakh 60. To only one of the liabilities taken, creditors 4 lakhs. For taking all these assets and liabilities, the purchase consideration offered being 51 lakhs 85,000. And tally and find out the difference, if any. The difference will be named as goodwill. Come on, tell me. I think you will be getting 11 lakhs 25,000. Okay, 11 lakhs 25,000 will be the goodwill here. Clear? So what about the payment made, sir? Payment made for the liquidation expenses. Right. It's only reimbursement paid by the selling company and reimbursed from the purchasing company 5,000. That 5,000 is already included in this as well as in this value. You no need to show it separately. Else you have to reduce the purchase consideration by 5,000 rupees. Then it is 51.8 lakhs. Goodwill be lesser by 11.2 lakhs. For that 5,000 rupees payment, again you have to pass one more entry, which is nothing but what? Goodwill upon debit to business purchase. That's how you can show one more entry. Like, so you don't need to show it separately. You can include here itself. No issues, right? Come on, make a note of it. With that, this illustration is completed.